Good morning, everybody. Hope you're doing well on this Sunday morning and welcome. So, I wanted to, first of all, apologize for not making it in on Thursday. I got into a little accident. I'll explain this coming week. And it was on Wednesday, and I tried to get going, but I just couldn't do it. So, I apologize, and I hope that didn't inconvenience anybody. All right, that being said, let's get started. So, the three chapters that I'm going to cover, and it'll be, quiz and intensive, if that makes sense, is that I'm trying to just make sure that I cover all the points that are on the quiz as much as possible. Well, at the same time, being comprehensive about the understanding. So, the three chapters we're going to cover today are production costs, monopolies, and perfect competition. Production and cost is this one's especially important because the cost structures in all of the firms are the same. And so whether you're looking at a monopoly or a perfect competitor, the cost background is always going to be the same. And I'll explain all that as we go along. So, and then we'll move into the other two markets today, and then we'll go for the other two next week. All right, so that being said, are we ready to start with production and cost? Here we go. So, production and costs, I guess the first thing to do is identify what the goal of the firm is. So, obviously, the goal of a firm is to maximize profit. And you might say that might not apply to all firms because there might be a nonprofit out there, but those folks still need to maximize profits to stay in business. In other words, whether you're, American Red Cross, is they still need to have as much profit as possible to be able to do their job, to be able to help with disaster relief or CPR training or whatever they're doing. So the goal of the firm, irrespective of the status of the firm, is always the same. It's to maximize profit. Okay, here we have total revenue, total cost definitions. So this is pretty straightforward. Total revenue is just the amount of money amount that a firm makes for doing business. The cost is what it costs them to do business, total cost, and then the profit is just the difference between those two. All right, cost is opportunity cost. So this is how an accountant looks at doing business a little differently than an economist. So for there's two types of costs that we're talking about, economics versus accounting. So explicit costs are just dollars and cents. So, you pay $1 for your electric bill, that's obviously an explicit cost. Implicit costs are opportunity costs. And I'll give you an example here that, for example, when I started working at Shasta College, before I worked there, I worked at CAL FIRE. So at CAL FIRE, I made $20,000 a year. When I started working at Shasta College, my pay went up to, say, $30,000 a year. So from an accounting point of view, like when I do my taxes, the total amount of my revenue was $30,000. From an economics point of view, when I moved over to Shasta College, my my revenue went up by only $10,000. The $20,000 I had to give up by virtue of making the move. And there's a little more explanation coming up here. So economists are economic profit. That's all about, the opportunity costs, and then the accountants is just dollars and cents. So here's a little column chart that shows, so this would be my situation. So when I moved over to Shasta College, I was making $10,000, but I had to give up $20,000 to do it. So I'm still better off, obviously, but the thing is I have to take into account that I gave up this CAL FIRE salary to do it. From an accounting point of view, it makes no difference. At the end of the year when I do my taxes, all they care about is this. All right, so here's a list of the costs that we're going to be dealing with. There's a couple more that will get added in later, but these are kind of the core costs. So the fixed costs are the costs that don't change with output. So it's something like rent or the cost of maybe core basic level electric or something like that. Variable costs are the costs that do change, and so a variable cost, if I had a pizza place, would be something like pepperonis or um, cheese or dough or something like that. So if I increase or decrease my output, the variable costs will go up and down. Marginal costs are the costs that change with each additional unit of output. So if I want to produce one more pizza, the cost involved in manufacturing that next pizza is the marginal cost. So I pay another $10 to make another pizza. That $10 for the next pizza is the marginal cost. Sunk costs, that we're not going to cover these too much, but sunk costs are something like if I bought a pizza place and I put a sign up in front that said Anthony's Pizza. When the new owners come along and they buy the building, they don't care anything about the sign. I'm never going to recover that particular cost because it says Anthony's Pizza on it. But so that's a good example of a sunk cost. All right, marginal product is the amount of product or amount of output you can produce with an additional unit of input. So marginal product, you hire another worker, they give you marginal product, meaning they give you a certain amount of output that you didn't have before. Diminishing marginal product is that as you add more units of input, you get more output, but at a decreasing rate. So the first worker produces 50, the next worker produces 40, so your total output is 90, and so on and so forth. We'll talk about that more here. So here's a table showing a production function for a cookie factory. And as you can see here, we have 0 workers, so there's 0 output. There's no marginal product of labor because no labor, no product of labor. The factory cost, this is the fixed cost right here. So the fixed cost each week or whatever is going to be $30. So whether we produce some or none, it makes no difference. This is the same each week that we're working or in business. Cost of workers for the first week is 0, and then the total cost, this is fixed cost plus variable cost. So this is the two costs added together. All right, so day 1, we come in, we hire a single worker. That worker produces 50 units of output. The marginal product of that first worker is 50. It's also, well, the marginal product is the first 50, but it's also the marginal product for that day. I'll talk about that in just a second. Fixed cost is exactly the same because it's the same every single day. Now we're paying that first worker $10. So that first worker makes $10. Total cost is now this plus this. And so your total cost is 40. All right, day 2, we come in, we hire a second worker, an additional worker. So now the second worker contributes, you can see here, an additional 40 units of output. So the total is now this plus this. All right, so the total now is 90. The factory cost is the same as it is every single day. Now the total cost of workers is $10 per worker times 2. And then the total cost of everything is going to be $50. So you can kind of see here what's happening is as we add a number of workers, we get more output, but at a decreasing rate. One more just for fun. So we add another worker. The total output is now 120. That's this plus this plus this. All right. The fixed cost is still $30. The cost of the workers is now $30 because we're paying 3 of them $10 a day, and your total cost is now 60. Right? So that's a total cost curve. So here's a production function that's coming from the table in the previous slide. So what happens here is, let me go ahead and go through this, get them all popped up there. All right, so this is just exactly the same thing that was on the previous table, but it's just obviously in the graphical form. All right, so day 0, we have 0 workers, 0 output, and everything is the quantity and the cost is set at 0. Next day comes, we hire a single worker. That worker contributes an additional, and the first 50 cookies, so that worker is here. All right, then the next day we hire another worker. Excuse me, we get an additional 40. And so now we're at 90 units. Another worker, we're at 120. Another worker, we're at 140, and so on. So you can see here that the output increases, but at a decreasing rate, and that's due to diminishing marginal product. Um, you might say with cookies, just as an example, that how would you have that much diminishing marginal product if you hired a second worker? And that, of course, that makes sense. But what happens is, I think, from at least the way I view it, and from I think hopefully an economics perspective, is that the first worker comes in and has sort of free reign of the kitchen, and they can put pans wherever they want, and they can kind of do whatever they want, and they don't have to worry about anybody else. When you hire a second worker, granted, the effect is probably cumulative. So it's affecting both workers equally, but we'll just keep it linear for our purposes. Is that the first, so you hire a second worker, and the second worker comes in, and now he or she has to wait, let's say a couple minutes to get the oven, or has to wait for a clean cookie tray or something like that. So their output is, they're not working less hard, they just have less output per hour because of diminishing marginal product. And when you're talking about one or two workers, it's probably not that severe, but the idea is the concept. All right, let's see here. So the total cost curve is obviously, as we incur more costs, so the fixed costs are going to be the same every single day or every single week. And then as we add output or add production, we get more variable costs and then the total cost curve is the summation of those costs. And I'll explain that in just one